Okay, so hi everyone. My name is Josh. I'm an information assistant at Vaughan Public Libraries. Glad to see that there's a lot of people here who are interested in learning about the world of stocks and just building your financial literacy in general. Learning about stocks, investing, all of that can seem like an intimidating venture. So my goal today is to try to explain things in a way that's easy to understand, try to make investing a bit more accessible, and hopefully help you get started off. Before we get into things, I just want to make it clear that this program isn't financial advice. I'm not a financial advisor, so I'm not going to be telling you what stocks to invest in, what an ideal stock portfolio looks like. These are decisions that will always depend on your own personal financial circumstances. I'm going to be assuming that you have no knowledge of stocks at all, and I'll walk you through the very basics of getting started. I'll also be talking about library resources that can help your investment strategies and financial goals. So, topic of investing is an enormous one, and again, what I want to do today is introduce you to these topics and provide you with a jumping off point for you to explore them yourself. I want to provide you with the tools and resources to improve your financial literacy. And even if at the end of this program you decide that stocks aren't for you, that's totally okay. Just want to provide with the information first and foremost, and you can decide what to do with that information afterwards. After this program, we'll also be sending out a list of resources and books that you can take a look at if you want to further your investing education. I'll also be taking questions at the end too about what I've talked about. So if you do have any questions, make sure to save them for the end, and you can write them down in chat, or you can just ask me after. Okay, so today's program will be broken down into 3 parts. Since I'm assuming that there's no prior knowledge at all, I'm going to be explaining the basic building blocks and getting you familiarized with all the terms. So I'll be talking about what a stock is, what the stock market is, different kinds of stocks, and what makes them move up and down. Once you familiarize yourself with those terms, I'll also be discussing the different investment approaches and strategies. Basically, the different ways people choose what stocks to buy and the resources that we at the library have to offer to help your financial goals. The last part will be more practical information, such as the basics of actually how to buy your first stock. So information about choosing a brokerage, different type of investments accounts, and placing your first trade. So why invest in stocks? One of the biggest reasons why people invest in general is because of inflation. Inflation is the reduction of your purchasing power, the purchasing power of your money over time. And this means that whatever money you do have today will be worth less in the future. You'll be able to buy less with it. And that's why decades ago, you could buy more with a dollar than you can today. To illustrate that, here are some grocery receipts from 1982. As you can see, there's only a couple of things that are over $3. Our grocery bills definitely don't look like that today as much as we would like them to. Inflation is unavoidable and will continue to happen well into the future. The government has an aim of trying to keep it below a certain percentage because too much inflation obviously isn't a good thing. But the current rate of inflation in Canada is 4.8%, which is the highest it's been since the early 90s, largely in part due to the pandemic. So why is this important when it comes to you? Let's say you have $10,000 worth of cash. Is that money, if that money's just sitting there in actual cash form, or if it's like stuffed under a mattress or in a no interest checking account, it's slowly and invisibly being chipped away by inflation. So you can put it into a savings account, but basic savings accounts these days are at about 0.01% interest a year, with a high interest savings account providing about 0.05%. So $10,000 in a savings account like that will only give you about $1 by the end of the year. That's definitely not going to help you keep up with the rate of inflation. So your goal is you want your money to at least grow 4.8% each year, just so it can be worth the same amount purchasing power that it's worth today. The interest rates for guaranteed investment certificates, GICs, aren't much better. With these investments, you're guaranteed to get the money that you put in back, but that comes at a cost of a low return. So this is where stocks come in. There's a conception that they're riskier, but over the long run, they actually outperform most other investments. So in comparison, the stock market, on the other hand, has done incredibly well over the long run. So here is a chart showing one of the indicators of market performance in the past 10 years. I know this chart and what it might mean to you might be unfamiliar, and I'll explain it more in detail in a bit, but just think of it as a snapshot of how the stock market has been performing. The market has grown 234% in the past 10 years. So your hypothetical $10,000 invested in the market 10 years ago in January of 2012 would have been worth $33,400 today. This rate of return well outpaces inflation, and not only does it protect your actual savings from inflation, but it also helps them grow beyond it, giving you even more money in the future. Another good reason why people invest in stocks is to have more control over their finances. So some of you may already be invested in stocks indirectly if you have a retirement plan or if you've bought into mutual funds. In both cases, your money and the money of others is pooled together to be invested by a fund manager. And a portion of that can be inside stocks right now, depending on the fund. So different mutual funds have different types of holdings, such as stocks and bonds. Some of them might be higher risk, while others are lower risk. Of course, you can make the decision based off of about which types of mutual funds you want to buy, but at the end of the day, it's someone else who's making the stock decisions for you. These managers also make money from you by taking a small percentage every year called a management expense ratio or management expense fee. This percentage might seem small, but just like inflation, it can also eat away at your gains too. So Canada, unfortunately, is notoriously known for having the highest fees in terms of mutual funds in pretty much the world. So not only are today's investors facing high inflation, they're also facing high mutual fund fees. So learning how to invest in stocks gives you more control over how your money gets invested and how much in expenses you actually take. So what is a stock? In short, it is a representation of ownership of a public company. So when a corporation wants to raise money for itself, say to buy more equipment, hire more people, develop more products, they go public. And what that means is they sell shares of the company to the public in exchange for capital. So a share is each unit of stock is called a share. Owning a share of a company means that you are part owner of that company. So you can think of the company as a giant pie that gets sliced into different pieces that a lot of people own. The share also entitles you to a claim of a company's earnings. And as a partial owner, you also even vote on some of the decisions that the companies make. Of course, your vote is proportional to the amount of shares that you own. So it's usually only the majority shareholders are the ones that are calling the shots. The price of a stock is also a quick way for you to see how much a company is worth. Let's take a hypothetical example of a company that's worth like $1 million. And the reason why we know it's worth as much is because they have 200,000 shares out distributed to the public, and each of those shares is worth $5 each, for example. So take the $5 share price multiplied by how many shares they have, and that's what gets you the $1 million value. This number is actually called the market capitalization, market cap for short. When the stock price goes up, the market cap goes up too. So recently you might have heard some news about, like, for example, Apple being the first $3 trillion company, or Netflix losing $50 billion overnight. What they're actually talking about is the market cap. So it's always moving. Some people think that when you buy a stock, you're giving money to the company itself, but that's actually not the case at all. The only time that you get money is when they get money is when they first sell the stock to the public in something called an initial public offering, IPO for short. Almost all the stocks that we as individual investors buy are from the secondary market. So we're buying stocks from other people or other organizations that already own it. So this leads me into my next topic, which is, what is the stock market? So this is where stocks are actually bought and sold. So it is like an actual market. So some people have an idea of the stock market being those stock traders on the floor of the New York Stock Exchange yelling at each other, which is sort of what I have pictured here. But the reality of that is much less exciting than that. The vast majority of trading is done through computers or online. Speaking of the New York Stock Exchange, there's no like singular stock market. The stock market is composed of different exchanges. So there's the New York Stock Exchange, which is the biggest one in the world and has many of the big companies that are traded in the New York Stock Exchange. Here in Canada, a lot of our stocks are listed under the Toronto Stock Exchange, so TSX for short. Another big exchange to be aware of is the NASDAQ, which has a lot of larger technology companies. So companies may be traded in only one of these exchanges, or they can be in multiple. It depends on the company. So you're free to buy stocks in any of these exchanges. And the biggest difference though is the currency denomination. For example, a stock like TD is listed in both the New York Stock Exchange and the TSX. You can buy either one of them, but the price listed on TSX is in Canadian dollars and the one in the New York Stock Exchange is in US dollars. Now, when trading on exchanges, you can actually haggle in terms of what prices you want to buy and sell the stock for. Of course, this is done with the goal in mind of buying the stocks at a low price and then selling them for a higher price. And that's just like the major principle of investing. The stock market is very much a market in the sense that you can offer to sell a stock at any price, but if it isn't fairly valued, no one's going to want to buy it. For example, like you just bought a stock at $10 and you immediately want to sell it again for $100. You can try to do that. You absolutely can. The problem is no one's gonna want to buy it. So generally, people buy with the expectation in mind that it'll go up in price and they'll sell it back when the market wants to buy the stock back for a higher price. So whenever you make a profit on the price of a stock going up, that's what's called a capital gain. If the price of the stock goes down, that's what's called a capital loss. The markets are generally open Monday to Friday from 9:30 a.m. to 4 p.m. and that's Eastern time, excluding holidays. And it's only between those hours that people can buy and sell, and only in those hours that the prices actually move. This is what's known as the trading day. So if you've ever seen like again, New York Stock Exchange, the bell ringing, the bell usually rings at the beginning and at the end of the trading day. Okay, one last thing I wanted to talk about in terms of the market as a whole. The media might report the market has gone up or down. And when people say things like this, what they're actually referring to is one of the market indices or a market index. So a market index is a group of stocks that are used as a benchmark to see how well the overall stock market is doing. There are a few different indices, but the one I want to focus on today is called the Standard & Poor's 500, the S&P 500 for short. That's what I have on the screen right now. These are the top 500 companies by market capitalization in the US. The performance of this index is based on the average performance of all the companies inside of it. The bigger companies in the S&P actually have a larger weight on the index. So for example, the biggest company right now is Apple. So when Apple has a really bad day, the index as a whole has a bad day. Anyways, this index is what's used to keep track of how the markets are doing. So when a market has been going up, or when the market has been going up over an extended period of time, that's what's generally called a bull market. And when it goes down over an extended period of time, that's what's called a bear market. There are different levels of bear markets. So sometimes small dips can be called corrections, while bigger dips are called recessions or even crashes. Examples of crashes in the market are, of course, the Wall Street crash of 1929. We also had the dot-com bubble of 2001 and the 2008 recession. So you can actually see them in the chart here. S&P wasn't established until they didn't start keeping track until the 80s, so you can't see the Wall Street crash here. But you can see around here in 2001, the dip that happened during the dot-com bubble. This dip over here, that was the 2008 recession. And this sharp dip is from the start of COVID. And basically, the big takeaway that you can see from this, from looking at the S&P, is that while those dips, when they happen, are significant, they're scary, especially when you're looking at it from a short-term perspective, over the long term, stocks have been performing well. Okay, so what exactly makes stock prices go up and down? The simple answer is supply and demand. So if a stock suddenly becomes favorable in the public eye, more people will want to buy it. So if a company launches a new groundbreaking product and all of a sudden millions of people want to buy the shares in that company, there might not be many people who have the stocks to sell. The people that currently own the shares will likely not want to sell it unless they get a higher price for it. The more demand there is to buy a limited amount of shares will cause the price of the stock to go up. The reverse is true for when stocks go down. If the company of a stock you own does something questionable or some sort of disaster happens that makes it harder for the company to make money, people will not want to buy shares in that company. Sometimes the company is so bad that the stocks can't be sold for cheap enough because no one wants it, and that's what causes the price to go all the way down to zero. By that point, the company is pretty much gone. So there's many reasons why this upward and downward pressure happens. New products or technology, like I said, can cause it to go up. Companies also release regular earnings reports to inform investors of how the company is doing financially. If those reports show that they're doing well, prices might go up. If not, they might go down. That's also no guarantee though, because sometimes companies might seem to be doing well when they aren't. And when it finally comes to light that they're not doing as great as they make it out to be, that causes the prices to drop significantly. So of course, you might be asking yourself, how do you know whether stock price will go up or down? And the real answer to that is no one ever knows because no one knows the future. But with proper research and choosing a strategy, you can have the tools to make the best educated guess for where you want to put your money into. Okay. We're going to take a look at a stock quote. So this is basically how you get information about stocks, about specific stocks. Information about stocks can be found by looking up the stock quote. You just need to search it up. This is what I get when I search for Apple stock, for example. Every company's shares are represented by a 2 to 4 letter stock symbol or ticker. So let me show you right there. Oops. Right there. So that is Apple's ticker symbol, AAPL. Right next to it, this is the exchange that it's traded on. So it's traded on the NASDAQ. This is the current price. So this is last Friday's price, actually. This red line represents the movement of the stock price throughout the day, starting from 9:30 to 4 o'clock p.m. And the reason why it's red right now is because it closed, so the last price at 4 o'clock, it closed lower than it did yesterday. So with the yesterday's closing price is represented by this dotted line over here. If it actually went over that, the stock price would be showing green, meaning that it made gains for the day. And of course, you can take a look at the different time spans up here too. So this is just for that last trading day, but there's also the 5-day, 1 month, all the way down to like since the beginning of when the company started trading. At the bottom, we have some more detailed information. I'll just go over that quickly. Open, that's the the price that it opened at today. You have the highs and the lows for the day, so almost like the weather report. We also have the 52-week high, 52-week low, so the highs and lows of the past year. Market cap, we talked about. Their market cap, they did hit $3 trillion, but now they've dropped down to 2.65 trillion. PE ratio is the price to earnings ratio. It's basically the price of the stock compared to how much they earn. And dividend yield is how much of a dividend that they pay out to you. And we'll talk more about dividends later, but it's basically them, the company paying you for owning the share. This CDP score, that's something that Google has, and that's sort of a new measure that it's nothing to do with the financials of the company. It's more of like how much of a green company that they are. Okay, so now that we've covered the basics of what stocks are, what the stock market is, I'm just going to talk about the different kinds of stocks that there are out there. First, I'll talk about three main broader stock classifications for individual stocks. So if you're buying the stock of a specific company, there's different classifications. And these classifications can be considered reasons why people buy certain stocks. And then afterwards, I'll talk about alternatives to individual stocks. So the first classification are value stocks. Value stocks are named as such because they can be considered as selling at a value. And what this means is that people consider these stocks to be selling cheaply, and they expect it to rise in price eventually. And when I say a stock is selling cheaply, I don't mean that it's selling at $10 or so. A stock can be overvalued at $10 and it can be undervalued at $100. So those who buy value stocks do so because they believe the true value of the company isn't really reflected in the current price of the stock. This can be for a variety of reasons. For example, companies that seem to be in trouble right now or at this moment, but they're still viable for the long term. And they might have an artificially low price because of that. So we saw a lot of examples of this when COVID first hit. The stocks of many big reliable companies plummeted drastically at the beginning of the pandemic, and that was for very understandable reasons. Everything was uncertain. People didn't know what was going to happen. They didn't know how long the pandemic is going to be happening for. So people and institutions who own shares of these companies sold them to cash out and basically have it as a safer form, which is cash. And then prices dropped significantly. Value investors realized that even though those prices dropped, the long-term fundamental value of the company didn't change overnight. And they would have seen this as a great opportunity to buy. So those who did buy when all the markets were dropping would have had to pay off because many of those stocks that plummeted in the spring of 2020 went up to all-time highs afterwards. So buying value stocks might seem nerve-wracking in the moment, but if you're doing so based off of sound information, proper research about fundamental value, that research can really pay off. The market has a pretty skeptical attitude towards value stocks, and that's why they're so low in price, because they're considered riskier. For a company to be trading at value, the market thinks that they're a risky company. So it might be psychologically difficult to invest in a value stock. And that's because you're going against the grain, you're going against overwhelming market sentiment. But of course, that's only if you're looking at it as a short-term view. There is always the inherent risk, though, of the prices of these companies never going back up and your investment continuing to drop. So the next category is income stocks. These are stocks that provide you with regular income through the form of dividends. Dividends are when a company pays you the profits that the company makes on a regular basis. So you get a small dividend for each share that you own. The more shares that you own in the company, the larger dividend payment you get. These are popular because on top of the price of that stock possibly going up over time, you also get paid for holding the stock too. So dividends can be paid monthly, quarterly, once a year, but more often than not, it's quarterly. The best part about dividends, though, is that you can enroll in something called a dividend reinvestment plan, DRIP for short. That's where if the dividends you receive are enough to buy you another share, you can actually have your DRIP set up automatically to buy more shares instead of receiving the dividends as cash. So sometimes companies even give you a discount on those shares that you buy with your dividends. So by reinvesting your dividends, your investment grows quite a lot over time. This is what's called compounding growth. So basically, you're buying more shares with those dividends, which in turn gives you more dividends to buy even more shares. So that wealth can grow quite significantly after once you hit a certain point. Example of income stocks are stocks that have regular and predictable income, such as phone companies, utility companies. They sort of already have a set customer base, and they're not focused on growing the company as much as other types of companies try to grow. They're often considered to be less risky, and they have, especially if they have consistent dividend growth. The cons for them, the biggest cons for them are the prices of the stocks themselves might not appreciate, they might not go up. They usually don't for these types of companies. And they can stop paying the dividend at any time. They can either cut it down to something lower or they can stop at any time. That's completely up to them. So final classification I'll talk about are growth stocks. So a lot of the big companies today don't provide dividends, choosing instead to reinvest their profits in the business to help it grow even further. This is basically, companies like that are basically called growth stocks. Growth stocks are also known as momentum stocks. They grow in price pretty rapidly compared to the other classifications that I've talked about. These are usually the stocks that you hear making the news. Rapid growth can be a bit of a double-edged sword, though. Biggest risk is it might not be sustainable long-term. These are sort of like the inverse of value stocks, where the value might not be reflected in the price of the stock, but in the opposite direction. So it might be overvalued. You may buy a stock because the price might be going up rapidly, and then one day the market realizes that the price is unjustified, and then the shares will eventually plummet. On the other hand, even if you're like cognizant of the risk of growth stocks and you decide to stay away, sometimes it can be pretty painful watching them go all the way up. It gives you the dreaded FOMO, fear of missing out, and which might make you cave and buy in. So with growth and momentum stocks, you have to try to not let your emotions drive your decisions and take control. Good case study of this is the 2001 dot-com bubble. So 20 years ago, when the internet started becoming widespread, any company that was thought to be tech or internet related started going up. Their stock prices started going up significantly. Some companies that weren't even related to the internet at all changed their names just to sound like an internet company. There was an example of a construction company that changed their name to something that sounded like an internet company. And then the price of their stocks skyrocketed. The market sentiment at that time was that internet companies couldn't fail. And basically they all went up until they didn't. Like a big inflation of prices is called a bubble. The bubble finally burst at the end of 2001. All the prices went coming down. So yeah, growth stocks, you do have the potential for higher gains with them for sure, but they are riskier. Most of them don't pay dividends, and their price to earnings ratio is very high. Okay, so I've talked about some classifications, but it's important to remember that those are, I was just talking about the classifications for individual stocks. With so many different companies out there, especially as a beginner, it might be hard to begin deciding what to choose. Thankfully, there are so many alternatives that you can buy that have made investing a lot more accessible to people who don't have the time to research all of these different companies, because it is very, very overwhelming to see how much choice you have out there. The first alternative is an index fund. So remember the S&P 500 index that I talked about earlier that tracks the overall performance of the market? You can buy an index fund which seeks to just emulate that. So if the S&P goes up 1%, your investment goes up 1%. So when you buy into an index fund for the S&P, you're essentially buying the top 500 companies in the US. This provides you with instant diversification. So all your money isn't in one stock. Technically, you're buying like 500 different companies. So instead of trying to beat the market, which is what the fund managers try to do, basically how fund managers measure their success is to see how much that they beat the market for, meaning if the market went up 5% in the past year, a fund manager would consider themselves successful if they made more than 5%, so like 15%. But a lot of fund managers don't really do that, don't beat the market as much as they like to think that they do. So instead of trying to beat the market, you can just sort of join the market and earn whatever the market earns. It may not sound as flashy as saying that you beat the market, but it is gains nonetheless. Also, management fees are lower in index funds because a fund manager isn't deciding what to buy, rather they're just emulating the top 500 companies. So next category are ETFs, or otherwise known as exchange traded funds. And that's basically a mutual fund in stock form. So these funds contain a variety of different stocks, and they provide you with instant exposure to many companies at once. They don't all only contain stocks, but they also have commodities, bonds, cryptocurrency, domestic, international stocks, lower expense. They usually have lower expense ratios too. Index funds can also be bought as ETFs. ETFs are a great way to simplify your investment decisions. So for example, if you want to buy income stocks, but you don't know which one to buy, you can buy an ETF that holds a variety of income stocks, and you get paid dividends from that. That way you don't have to do research on individual companies to see which ones are the best income stocks. You obviously have to do research in terms of which of these ETFs to buy, what's actually contained in them, but it's not as time consuming as doing research on individual stocks. They also have a lot of other categories too. For example, there's even like green energy ETFs, which hold companies that focus on sustainable efforts. Again, ETFs provide you with access to so many individual stocks at a lower per share price, and it provides you some good diversification on top of that as well. So, the next one is REITs, or real estate investment trusts. So investing in real estate can be a complicated venture and can be capital heavy process, and REITs make it a lot easier and more accessible to people who want to profit off real estate, but not actually want to buy the properties and rent it out. Basically, REITs are companies that own properties. Then they collect the rent every month, and then they pay out the rent to the shareholders. So if you buy a REIT, just like you buy a stock, and you get something that's like a dividend every month, paying you part of the rental profits. These REITs own a variety of residential or even commercial properties, and they can be another regular source of income. So the benefit of it is it provides liquidity. Exiting real estate is a hard thing to do. You can't just sell a house right away, but you can just sell a REIT right away if you ever want to get out of real estate. They have similar qualities as income stocks in the sense that they pay out money to you regularly, and you don't really buy them with the expectation that the price will go up. You just buy them for the consistent income. Okay. So yeah, those are the different types of stocks out there. Next, I'll be talking about basically different strategies in terms of how to choose these stocks. There are two main approaches to investing. There's an active approach and there's a passive approach. Active investors do a lot of research on many different companies. They look into their financial statements to determine if the company is a good investment. This approach can come with higher gains, especially if you're able to find some particularly undervalued companies, but it also does come with higher risks too. Another sort of drawback is that if you want to really invest actively, it can be a time-consuming and research-intensive approach. So I want to talk about two different types of active investing before I talk about passive investing. So the first approach for active investing is fundamental analysis. Here, people who use fundamental analysis take a look at the financial statements of companies to determine if they're undervalued or overvalued, and that's compared to their stock price. If they're undervalued, then they buy them, but basically they do a lot of research on value stocks. Another type of research includes technical analysis. Those who use technical analysis read stock charts and they look at the patterns of the stock price movements. And they see if these patterns will tell them if the stock price will go up or down. These patterns are called technical indicators. This type of analysis assumes that the future of a stock price can be predicted by looking at what it's done in the past. Now, both technical and fundamental analysis require a lot of specialized research about those techniques, first and foremost. So some people swear by one type while others use a mix of both. At the library, we have plenty of books about both those methods. The alternative to active investing is the passive approach. And this is what's sort of more suited for a lot of people, especially beginners. Passive investing can be summed up by just buying and holding. So when you invest passively, you're not really researching the market as extensively as those who invest actively. Your main strategy is mostly buying and holding on to stocks with the more long-term view that you're not always checking to see what the price of the stock is on a regular basis. This strategy can be used on individual stocks, but is mostly used in conjunction with ETFs, specifically index funds. Employing this strategy means you're not always trying to beat the market, you're just trying to earn the market's returns. So there's another method of passive investing, not really a method, but it's a strategy of passive investing where it's called dollar cost averaging. And basically what you're doing there is you're buying a set amount of stocks or ETFs each month on a regular basis. So say, for example, you buy $500 worth of an index fund tracking the market. So in a month, and you do that every month. In a month where the market's doing well, your $500 doesn't actually buy you a lot. So you're not buying too many shares when the prices are high. But when the market is down, your $500 will be buying you more shares. So you're actually buying more when the market's down and less when the market is higher. That's what it means to dollar cost average. This way, your gains are sort of like you're consistently investing, putting money aside for your future without having to think about how much you want to put in each month or which stocks to buy, which stocks to sell. So in comparison to active investing passively, with investing passively, your gains and losses aren't as dramatic as those who invest actively, but they will be more consistent, especially if your passive investing consists of index funds. You don't have to spend a lot of time deciding which companies are overvalued or undervalued. You're just systematically putting money into the stock market and waiting for it to grow. Okay, so those research methods that I've talked about, we do have a lot of resources to help with your stock research. We have our biggest thing that we have is our physical collection. And for me, that's, in my opinion, that's the most useful thing that we have. We have so many books about pretty much every aspect of investing, from technical analysis, fundamental analysis. If you want books about passive investing, there are many that cover different strategies in terms of that. They contain a wealth of knowledge that's helped me in my own financial goals. And I'm pretty confident that they can help you too. I'll be sending out a list of my recommendations, which cover a variety of different topics that we talked about today. I'll be sending that at the end of the session. We also have subscription sites such as LinkedIn Learning, which provides videos by industry professionals that cover professional development topics. So it's not a website focused on investing in stocks specifically, but it's a great place to start if you want to find some short videos explaining more specific stock investing topics. So example, like I just searched up investing, and what popped up was a 5-minute video about like investing with ETFs. There's also building your financial literacy. And for those who are looking for some more advanced stuff, there's also that algorithmic trading and stock essential training. And you can see those ones are a bit longer. So variety of different topics at different levels and different lengths. What else? We also have the subscription to the New York Times and their financial section as well. If you want to keep up with up-to-date information about what's going on in the economy, different sectors, or in individual stocks. That same kind of information can be found. This is their market page. The same kind of information can be found in many of our subscriptions to our business magazines that we have. So such as like Bloomberg Business Week, The Economist, Forbes, Harvard Business Review. We have them in branch, like the physical copies as well as digital copies too. I even have this big binder over here, hopefully you can see it. It's called the Investment Report, Canadian Investment Report. It has a lot of information about, it's a regular report that we get that has information about what's happening in the market. Actually has some recommendations in terms of what companies to buy sometimes, or different strategies that can be used. So yeah, that was, so the best part about all these resources is that they're already helping you with your financial goals, because they're all free with the use of your library card. But yeah, they're great resources that you can use to decide what kind of plan you want to make for yourself. And again, all based off your own personal circumstances. So now, after doing your research, after choosing an investment strategy, what stocks you want to buy, there actually comes the business of buying stocks. So again, this process can be intimidating for those who haven't done it before, but I'll go over the 3 first steps that you need to take when you're buying stocks for the first time. And this includes which investment account to choose, which brokerage to choose, and also placing your first order. So first, we're going to talk about the investment accounts. So one of the things you need to consider when buying stocks is what sort of investment account you want to hold them in. There are many different accounts that you can open. They all have different uses and tax implications. So think of these accounts as the basket that you hold your investment in. And each of these baskets has different rules. So I'm sure many of you have heard about some of these accounts already. And although most of these accounts have the word savings in them, they're not just used to hold like savings accounts or cash, bonds, GICs. They're used for stocks too. And you can open up any combination of them as long as you're eligible to open up these accounts. So the first one is TFSA, so tax-free savings account. This account was made in 2009 by the federal government as a way to encourage Canadians to save more money. Generally, when the price of your stock goes up, you have the capital gains. You actually get taxed for those capital gains. But in a TFSA, you don't get taxed for capital gains at all. You don't get taxed for Canadian stocks or dividends. So when you sell the stock, you won't be hit with any of those taxes. The catch for TFSAs is that there's a limit to the amount of money that you can place into the account. And that's determined by your current age and when you turned 18. So you get a specific allowance of how much you can put into your TFSA at the beginning of every year. So in recent years, this has been approximately $6,000 a year. So someone who turned 18 at the first of this month can only contribute $6,000 to this account. And someone who turned 18 on the year of 2009 or before, which is when the TFSA was introduced, you're able to contribute $81,500. So any gains that you make on that $81,500 are completely tax-free. Since this perk of tax-free gains is so beneficial, the CRA is very strict with the contribution limit. So you can't go over it at all, or else they penalize you. So always double check to see if you're close to hitting it. That information can be found from the CRA website, or you can log in where you log into your account, or it gets provided to you during your tax returns. Withdrawing money from your TFSA is tax-free too, but they have these weird rules where, for example, if you draw $5,000 from it, you can't add it back. You can't add back $5,000 right away. You need to wait until the next year to do that. So that year, $6,000, assuming that next year is $6,000, they'll add it back. They'll add it to that. So your new contribution limit for additional contribution limit next year is $11,000. If you own multiple TFSAs with different brokerages, the contribution limit applies to the combined amount of all the accounts. So make sure to keep that in mind. If you already have a TFSA that has like a savings account in it, and you want to open up another one just to use for stocks, keep that limit in mind. TFSAs are great because they also have the lowest barriers of entry, and they give you the most flexibility. Even if you aren't investing in stocks, if you're putting money aside, if you're like in bonds or GICs, there's no reason to not have a TFSA. RRSP, so Registered Retirement Savings Plans. This account is used for your retirement. So in any sort of investments that you have in this account, you will be taxed on it, but those taxes are deferred to when the money comes out of your account during retirement. When you place money into it's tax deferred, and what this means is when you place money into it, you actually get a tax credit back for some of it the following year. Your RRSP gets converted to a registered retirement income fund at the age of 71, which then it will be used as a source of income. So gains here are not tax-free, tax deferred. That's because when you draw money from an RRSP, the CRA considers it as income. And this is not the case for TFSAs. So you're taxed at whatever your marginal tax rate is. There's also contribution limits to be aware of. Your contribution limit is 18% of your annual income to a maximum of $27,000 a year. And one more thing about RRSPs is that the only condition for opening one up is that you have a job, you have income. So it's not age restricted like a TFSA, meaning a 15-year-old can open an RRSP if they have a summer job, but they can't open up a TFSA until they're 18. So what happens if you hit the maximum amount of money that you can put in your TFSA and your RRSP? Well, good for you. If you want to keep investing beyond that, you can put money into a non-registered account. The rules for a non-registered account are pretty simple. There's no limit on the amount of money you can put in them. But the big downside is that all the gains and income that you make in this account are subject to taxes. So you'll be taxed on capital gains, and you'll also be taxed on dividends as well. The registered RESP, Registered Educational Savings Plan, that's used to save up for your child's post-secondary education. Earnings made in this account are also tax-free. The government encourages, it's tax deferred, sorry. The government encourages you to use these plans to save up for your child's education. And they do that by matching the amount of money that you put in up to a certain point. So this matching is depends on your family income, and it's capped to $7,000 a year, but that's money that the government gives you for investing in your child's future education. And if your child doesn't pursue education after 36 years of the account being open, the government can ask for that money back. Also, this money is explicitly to be used for education. Otherwise, you're taxed 20%. And the last account I'll talk about is a Registered Disability Savings Plan. And these are meant to help those with disabilities and their families to save up for the future. There's no special tax exemptions in this type of account, but just like in RESPs, contributions into this account are matched by the government. And that's done through the Canadian Disability Savings Grant. So every dollar is matched up to 300% to a maximum of $3,500 a year. And lower income individuals receive $1,000 a year in this account from the government. Now, this money can be invested into stocks just like all the other accounts. And people with disabilities can choose what they want to use the money on and when they want to withdraw it. So there's no restrictions like there are for the RESPs. Okay, once you've decided on what type of account suits your needs, you'll have to choose stock brokerage. So this is the platform where that you use to actually buy and sell. Brokerages can come in many different forms, including professionals that process the trades for you, or the option that's probably the best for most people, which is doing it online through an app or through a desktop. There are many different options in terms of brokerages with different pros and cons. So choosing the right one will again depend on your own needs and your circumstances. So I'll talk about some of them. Many of the big banks right now provide direct investing services that allow you to buy stocks through them. When you set up an account with them, you just log into your direct investing portion of your account, and that's how you buy and sell stocks. Online brokerages provided by banks have the benefit of giving you a lot of research tools about stocks. They also have the benefit is that they provide pretty much all the account types that I just mentioned earlier. The biggest downside, though, is that pretty much all of them charge a trading fee of around $10, meaning that every time you buy and sell a stock, it costs $10. So you need to make at least $20 worth of gain for the trade to break even. This might not be a problem for large quantities traded, but it will eat into smaller investments if you trade frequently. An alternative to banks or online brokerages that provide you with lower fees and try to make investing more accessible. So one app that can be good for beginners is called Wealthsimple Trade. Wealthsimple will allow you to buy and sell Canadian stocks with no trading fees. The only catch is that they have a conversion fee when buying American stocks of 1.5%, both when you buy and sell. But other than that, they were the first platform in Canada that also offers fractional trading for a limited amount of stocks. And basically, what fractional shares are basically a share of a share. So instead of buying a full share, you're just buying part of a share. Why is this useful? So if you wanted to buy a share of Amazon today, that would cost you $2,800 US. I don't think many of us have the means to just buy like 100 Amazon shares. So fractional investing allows you to buy a fraction of the share. So you have exposure to like Amazon without having to buy the full share. If you only want to buy $100 worth of Amazon share, that's what fractional investing allows you to do. So Wealthsimple Trade is light on features other than the low commission and the fractional investing. They don't really have any inbuilt investment research tools, and you can only trade on the app and not on desktop. And we have a few other brokerage options as well. There's Questrade and Interactive Brokers. They both provide lower fees, but not necessarily no fees. Interactive Brokers is the only other broker that provides fractional investing. And National Bank Direct Brokerage is the only other brokerage that provides no fees. Okay, so there's a reason why I left this part for last. Once you've done your research, chosen your account type, your brokerage, put money in your account, it's time to make your first trade. And what we are going to take a look at a trading screen. So I put up two different order screens up, and one is from TD, one is from Wealthsimple Trade, just so you can see how similar and how different they are from each other. But the basics are pretty much the same. So let's take a look at the TD one first. For both TD and Wealthsimple, I'm trying to buy a stock of VFV, which is a S&P 500 index ETF. So when you look at this stock symbol up here, that's a symbol that you use to search up the stock. The Canadian flag shows which denomination, which currency you're buying it under. So if it's under the TSX, it's a Canadian flag. If you're buying American stocks, you'll see a US flag. This is the price of the stock, $98.26. You're going to see there's two different prices here. One's called the bid, one's called the ask. Bid is the price that you'll get if you try to sell it. And ask is the price that basically the price, if you're trying to buy it, that's the price you're going to be paying. Let's see. So the bid will always be, sorry, the ask will always be higher than the bid price. Okay, so this is the same screen for both buying and selling. So when you're buying, make sure you have selected buy. Quantity over here, pretty self-explanatory. If you want to buy 10 shares, you put in 10, which is what I did. In the Wealthsimple screen, on the other hand, here I chose the fractional investing just to show you what that would look like. The quantity isn't the amount of shares, but rather the how much money you want to invest. So instead of buying a full share of VFV for $98.26, if you want to just buy $50 worth, you can put in $50 and then you'll get about approximately half a share of VFV without having to buy the whole thing. And finally, order types. Let's just talk about those briefly. So when you're on the screen, you're actually placing an order for stocks, like ordering something from Amazon. You basically place an order, then you have to wait for the order to get filled. There are many different order types, so I'll just go over two of them, which are the most used ones. The first one is a market order, right over there. Market order is basically you're paying whatever the market price for the stock is. You're basically saying, I'm okay with paying whatever this price is. It's the simplest option, and this one will also allow your order to be fulfilled very quickly. You're basically saying, yeah, I'm okay with paying that price. In contrast to limit orders, which is right over here, a limit order is where you set the price of how much you're willing to pay for the stocks. So for each share, this is how you haggle. So basically, if you say you don't want to buy a full share of VFV for say you want to buy a share of VFV for $98 exactly, instead of $98.26. You can put in a limit order saying you're willing to buy it at $98, and then you basically just wait until that order gets filled. So that'll only get filled if the price drops down to $98. Downside is that the order might not get filled right away, or it might not get filled at all. But what this does is it gives you more control over how much it is that you're paying for each share, which can be important if you're buying a lot of money, sorry, a lot of shares, and every single cent sort of matters. That's where it can be important. So yeah, that's how you buy your first stock. That was a whole presentation. So this was meant to be a first step. There's many more to take, a lot more to learn about. So please take a look at the list of resources I'll be sending out afterwards, along with the book list. I tried to cover a variety of different investing topics. Another way to learn is through experience. So a lot of your learning experience will come from actually investing and seeing how it works yourself. Even if you feel like you don't have enough money right now to invest, or maybe you can't even invest because you're not 18 yet, there's stock market simulators that you can use to practice. I used one for like one of my classes where you're given about $100,000 in fake money for you to invest in. They use real daily stock prices to see how well you've done. This is a great way for you to see how your investment would have done without actually losing anything yourself. So I'll also be including that in my list of resources. And if you'd like to get in touch with me about anything that I've talked about, here's my email. It's also the same email that I used to send out the Zoom link. If you just want to respond to me using that. I'm not a financial advisor. I'm gonna make that clear one more time. I'm not gonna offer you stock tips or anything like that, but if you want recommendations on books about value investing or about technical analysis or books with good passive investing strategies, I'd be happy to give you recommendations to any of those. Feedback would also be appreciated too. If there are any topics that weren't covered today, or ones you think I could have delved deeper into or that could use their own programs, just contact me and let me know. Again, also, if there's a topic I didn't talk about at all, get in touch and I'll point you in the right direction. So I think right now I'm going to stop the recording and then we'll take some questions. Feel free to type in chat or unmute yourself or message me or Nina. Nina is named as Nina VPL.